I've been seeing a lot of videos recently on the stock market crash and how this is going to be the next financial crisis, 2008. You have the term private credit. It's the most searched it's ever been over the last 5 years. You have the fear and greed index at extreme fear territory, and a lot of people are sending me videos. They're telling me, I'm a new investor and I'm seeing this video. It's saying private credit is the next 2008, and they're scared and they're worried. Now, I believe some of those concerns are real, but I think they're massively, massively overblown. I don't believe private credit is going to be the next 2008, and I don't believe the stock market crash or pullback is going to be as extreme as a lot of people are saying, and I'm going to tell you why in this video, and I really hope you enjoy it as always. Now, this is the first kind of post that gets a lot of attention, which is mainly the financial institutions or the bank's exposure to private debt or private credit in general. If you look at the notional numbers, they're pretty much crazy. JP Morgan has a $22 billion exposure to private credit. Bank of America, $33 billion. Wells Fargo, $59 billion. Those are astronomical numbers for those banks. And it's just, again, it really scares a lot of investors. And it feels like this is the next 2008. Or if you look at charts of the default rate, it's like 7 or 8 or 9% higher than the 2008. And again, it scares off a lot of people. But what I asked this person is, now show me those numbers as a percentage of their book. So what is the percentage of their book that's in private credit? Someone else pulled up the chart and the numbers would surprise you. For JP Morgan, yes, they have a $22 billion exposure to private credit, but as a percentage of their book, it's only 4.2%. This is much clearer, right? 4.2%. Bank of America is 5.8. Wells Fargo, you could say 12%. Yes, this is a big deal. The default rate is like 9%. If we have a 50% default rate, that's like how much? 6% of Wells Fargo's book? So is it really the worst deal in the world? Is it the next 2008? Then they don't have as much exposure as they had on those subprime loans and other kind of loans. So to me, again, if you look at it as a percentage of their book, it's not as bad as you would see it on X. And it's the same thing with BlackRock. This is another post saying BlackRock, $26 billion private credit fund, is limiting how much investors can pull out, capping withdrawals at 5%, even though investors asked for 9.3%. Now, I explained this before, that those strategies are illiquid, and those kind of loans in the private markets, it's a private market, it's an illiquid strategy. You can't just call in and demand 10 or 20% of your money. So there's a pre-negotiated 5% cap every 3 months, every quarter, and they pretty much reach the cap. BlackRock did not tell them you just can't have your money back. But if you look at BlackRock, the stock is down like 10% on the month. It's down much, much more than it was before. But if you look again at the $26 billion and how much the stock is down, you believe that this is the next 2008. Now, if you look at those funds or the private credit as a percentage of their book, could you take a guess of what it could be? Maybe 10% of the book, 20%, 15%. It's only 3%. 3%, guys. 3% of BlackRock's book is an alternative, okay? Now, it's actually 16% of base fees. So it's 16% of what you could say profits from those funds, which is a large amount. But if you break it down even more, because alternatives is not just private credit. They have real estate in them. They have private equity, which is different. They have infrastructures. They have liquidity alternatives and liquid credit. Those are not really the bad part, which is private credit. Now, private credit as a percentage of fee-based AUM is less than 20%, or it's about $146 billion, which is really nothing. So BlackRock is managing $13 trillion. Out of the $13 trillion, $146 billion is in private credit. Do you believe BlackRock is going to zero? Do you believe the company is going to end? Do you believe this is the next 2008? So no one really looks at those things. They just put in headlines to get a lot of attention. And again, fear gets attention in general and all these kind of things. And I think it's scaring investors for no reason. I acknowledge that some companies like Blue Owl and others are overexposed, but this is definitely not the next 2008, with most banks having less than 5% of their book in those private credit. And even if you assume a 50% 8% default rate, which is unheard of. Subprime, I think, was like 7 or 8%. But let's assume 50%. That's like 2% of the book, 1% of the book. So again, I'm not saying the next 2008. Now, what I believe the market is worried about in general is not much about private credit, and it's more about the Fed. And the Fed said something very interesting in the latest FOMC meeting, and they said the possibility that the next move might be a hike did come up. So they actually discussed a potential rate hike. That's really crazy. And it's again mainly due to the uncertainty from higher oil and natural gas prices, which could increase the prices of shipping other items. And therefore, other items would increase in shipping and increase in cost. And it could cause inflation to surge again. And that has pretty much wiped out the chance of us having any potential rate cut during the next meeting. In fact, the chance of the Fed leaving rates where they are is about 92.8%. And that's really a big difference. Now, if you look at it into, I should say, September, in September, there's a 17.5% chance of a rate hike between now and then. 17.5%. That was at like 1 or 2%. It jumped to 17%. And I think this is what's scaring off the market. And this is what's scaring off gold in general. Gold trades really well whenever you have real rates, which is again the 10-year, or you could even say the Fed funds rate minus inflation. Once the real rates are positive, gold, generally speaking, tends to struggle. And if the Fed wants to hike rate, we saw what happened in 2021. Even though we had inflation, gold went down. I think this is the same thing that has happened to gold this time around. I don't believe it's going down because the Arab Gulf states are selling their assets to raise money, which is ridiculous. And I highlighted this point. I think it's due to potential Fed rate hikes, just what happened in 2021. The playbook playing again, and that's causing some fear in the gold market and some fear in the markets in general. Now, I did tell you guys that I'm not a perma bull, and I talked about this market pullback before it even happened. And I told you I had 10% cash or more going into 2026, and I had put options on the NASDAQ, and I was targeting 540 on the NASDAQ. So I'm not just talking about those things, I'm actually betting on them. I'm positioning my portfolio for them. And this to me is like the worst case scenario. I'm not seeing more than a 7% pullback from here. I still have my cash position. I still have the put options. And normally, whenever we pull back on the market, we tend to reach the previous high. This is what we did in April. We reached the previous high of whatever was the high before the drawdown of 2022. If we do go down this time, I don't believe we're going to go down more than 8%, which is around 535 to 540 on QQQ or the NASDAQ ETF. I think this is likely. What's making me believe that we could potentially get there isn't just things around valuations, although valuations are still extended and there's some optimism in general, and you could say potential Fed rate hikes or uncertainty around the Fed, but it's also the dollar. And I talked about this before. The dollar is near its 20-year support all the way down from 2008. Whenever the dollar hits the support and it starts going up from here, it's very hard for stocks to go up while the dollar is going up. It's extremely, extremely rare. It could happen, but it's rare. This is what happened in 2021. This is pretty much when the market peaked. And once the dollar started going up, the market started to go down and gold went down and other assets went down. And it looks like to me it could potentially be the same setup where we touched the trend line, we started to somehow go up. If this is sustainable and the dollar goes up even more, it's really hard for me to see the market really, you could say, going up at the same time. But I'm not really seeing anything worse than 8 or 7% on the downside on QQQ, and I will likely be adding aggressively in this period. But that was my opinion on the market and the whole fear with private credit, which I believe is unsustainable and it's really overblown in general. And if you'd like to join me in my group and you could know what I'm buying, what I'm selling, I share everything in real time. This is the link if you're interested. But thank you again, not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.